We detected an unusual trade worth $10.4 million on the iShares 7 to 10 year Treasury Bond ETF, ticker symbol IEF. Now, this is not your average trade, and it's happening right as the market is crashing from the impact of President Trump's newly announced tariffs, which have triggered a sharp sell off across stocks. But here's the interesting part. While stocks are crashing, this wealthy investor is making a bold move into medium term bonds, and it could be a smart bet. Why? Because if the economic fallout from these tariffs worsens, the Federal Reserve may be forced to cut interest rates to stabilize the market. And when interest rates fall, bond prices, especially medium duration bonds like IEF, tend to rise. And so in this video, we will break down this $10.4 million trade, the strategy behind it, and how smart money is positioning for a potential bond rally in the middle of a market crash. Because as we all know, the rich often have access to exclusive research, advanced analytics, and sometimes even leaked insider information, giving them an edge to make smarter financial moves. That's how smart money stays one step ahead, long before the rest of the market catches on. No wonder the rich keep getting richer. And so, to level the playing field, let's dive into our analysis to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, the most unusual trade happened on April 4th at 12:55 at the 28-second mark for these June 20 options at the 105 strike calls and the September 19 options at the 102 strike calls. 110,000 contracts were being traded. And so we can calculate the total cost of this trade, the price of 1.30 minus 0.035. Keep in mind that options are priced per share, so we need to multiply by 100 since each options contract represents 100 shares of stock. And so each contract or trade costs $95. And since there was a total quantity of 110,000 contracts, we multiply that out and we get a total of $10.4 million for this trade. But keep in mind, this trade is based on a macroeconomic bet that the Fed will cut interest rates in response to the market crash, making this a higher risk trade in comparison to the trades that we share on our website. And so if you want to get access to the lower risk and higher probability of profit trades, then go to our website. We'll put a link to our website here where you can get deep insights into exactly when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, with that said, even though this is higher risk, we still traded this, but we use position sizing to manage our risk. As you can see here on the option chain for the June 20 options at the 105 strike calls, since this was a new opening trade, we also traded these call options and got into the same position here. POS stands for our position, and the red color means a sell position. Now, how do we know these were new opening trades? Well, notice these options have an open interest of 101 contracts, which is much less than the 110,000 contracts being traded. It would not be possible to close out 110,000 contracts if there were only 101 open contracts. And so we can conclude that this wealthy investor was opening new contracts and not closing out contracts. And based on our analysis, this investor was selling these calls and combining it with another option as part of their overall option strategy. And which option was it? Well, as you can see here, for the September 19 options at the 102 strike calls, we also traded these call options and got into the same position here, in which the green color means a buy position. And again, notice how these options have an open interest of just 384 contracts much less than the 110,000 contracts. So we know these are also new opening contracts and not closing contracts. This data is very important to figure out because if a wealthy investor is closing out contracts or trades, it could mean they're worried about that stock. So maybe it's not the right time for us to jump in. On the flip side, if a wealthy investor is opening contracts, like in this case, it could signal an opportunity for us to start a new trade. And so we always take this extra step to analyze the data at a deeper level because many other websites and scanners don't. They report all high volume unusual trades without filtering out closing trades, which leads to wrong results and losses for those following unusual option activity. And that is why we have more winning trades than other websites. Now, with that being said, not every trade will be a winner, but as long as we diversify our portfolio with high quality stock picks backed by strong data analysis and use option strategies that can gain more than what we could lose, then we can stay consistently profitable over the long run. And so, if you want more trades from wealthy investors to diversify your portfolio, go to our website. We'll put a link up here where you can get access to more opportunities and strategies to increase your profit potential. Now, back to this trade, let's break down the data even further. Based on our deep research and analysis of multiple variables and other data sets, this wealthy investor bought these 102 strike calls together with the other June option as an option strategy known as a diagonal spread for a price of 95 each, the same price as we calculated and saw earlier on the options time and sales tape. And so when we analyze this trade, you can see here on the risk profile profit loss graph where the x-axis represents the share price of the ETF, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, as the share price goes down, this trade becomes more negative loss. And if it trades above it as the share price goes up, this trade becomes more positive profitable. Because this is a long bullish trade on bonds, specifically the IEF ETF. But keep in mind, this trade depends on Fed decisions and market volatility. That's why we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here where you can also learn more trading strategies to increase your profit potential. Let us know in the comments. Do you think the Fed will step in and cut interest rates? And are you bullish or bearish on Treasury bonds? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.